Now we're going to take a look at three of the most common financial reports you will be receiving regularly throughout the year and what you can learn from them. First is the Statement of Financial Activities, known in the business world as a profit and loss statement. The Statement of Financial Position, in the business world it's called the balance sheet. And finally, a Statement of Functional Expenses, which doesn't have an equivalent in the business world. So the Statement of Financial Activities is one of the most useful pieces of information you can get. This is a report that will come out at regular intervals. It might be monthly or quarterly, and it's going to tell you exactly where the organization's income and expenses for a specific period of time are, and it will compare them to what you had budgeted for that period of time. It will show you comparing where you are versus where you thought you would be, where you planned to be at this point of time in revenue and in expenses, and will tell you where you can expect to be at the end of the fiscal year, so you don't have to wait and find out in shock and dismay, but you will know way ahead of time where things are looking to go. Reading a statement of financial activities will help you answer questions such as, at this point in time, known as year-to-date, YTD, what percentage of the revenue that we thought we would receive, that we had budgeted to receive, what percentage of that has actually been received? And what percentage of the total expenses we had budgeted have at this point in time been incurred? So let's say you're halfway through the year. Is the revenue you have received, that you have recognized, half of what you had budgeted to be? Are your expenses half of what your total budgeted expenses are? And they won't be exact, but how big is the difference? And that difference between actual and budgeted is known as variance. The Statement of Financial Activities can also tell us how we can expect the year to end, what the balance will be at the end of the year, known as actual/forecast. And this is a concept that basically says, let's take whether revenue or expenses, what has actually happened in, let's say, the first 3 months or 6 months, and add that to what we budgeted to happen for the remainder of the year, for the final 3 quarters or the final half the year. And together that is the actual/forecast. And this financial activity statement will tell us what our actual/forecast total revenue will be, total expenses, and therefore total balance. And we'll compare that to the original budgeted revenue, expenses, and balance. Basically saying we know what's already happened so far, and if we add that to what we expect to happen for the rest of the year, where will we end up, and how does that compare to where we thought we'd end up when we first created the budget? It will look at the balance from last year and help you compare this year to last year, and will help you identify reasons for significant variances. Of course, no year is going to look exactly like the budget. But when there are significant differences, this report can help you identify what kind of revenue or expense is significantly different, and at what point in time was there a very bad month, or a very good month? What made the change, and where did it occur, and how did it occur? If you are more visually oriented, here is a very simple diagram that shows total income minus total expenses, leading to a net surplus or a net deficit. Now, here is a really great statement of financial activities template. It's more detailed than many you will see, but that's kind of why I like it. So the first thing to notice is that the first piece of information you see is the month June. So this tells us that this report has been generated right at the end of June. We don't know if this organization runs on a calendar year, January through December, in which case at the end of June we are now halfway through the year, or it might run on a state fiscal calendar, in which case, which runs July 1 through the end of June, in which case this is the last month of the year. But for the moment, let's imagine it's a calendar year, and this report has been generated right after June finished, so we are halfway through the year. First, on the left column, you will see all the line items of your budget. They may look a little different than this, but it will have every line item in as much detail as you wish from your budget. Then it's going to tell you what you actually received and spent in the month of June and the balance between revenue and expenses. And it will compare that to what you had put in your budget for June for revenue and expenses and balance. And it will tell you the difference, the variance. How has each revenue, each expense, and your balance compared in that month to what you originally thought would happen? And it does that again, but this time it's doing year to date. What has happened in the year that's already happened? And we said, let's assume this is halfway through the year. So in the first half, the first 6 months of this year, what is the total revenue you have received from each source of revenue and the total expenses you have incurred for each type of expense, and what your balance actually is year to date, and compares that to when you made your budget, where you thought you would be halfway through the year in revenues received and in expenses you incurred, and what you thought your balance would be at the halfway mark. And again, it compares them and gives you what's the difference, positive and negative for revenue, expenses, and balance at this point in the year compared to where you thought you'd be at this point in the year. Then finally, it's going to repeat your full annual budget here when you first created your budget, the totals you expected for the full year in revenue and expenses, and compares them to my favorite concept, actual/forecast, which is the totals of what has actually happened year to date in revenue and expenses, plus what your budget said would happen for the remainder of the year, the second half of the year, basically saying if from this point on life continued the way I budgeted, plus what's actually happened so far, this is what our totals will be, and this is where we will end up, and what is the difference between them. And finally, to what I think is the most important cell to look at in this report, which is the actual/forecast balance, telling you at any point in the year what's already happened, and if life were to continue the way I've budgeted it for the rest of the year, this is what my balance will be at the end of the year. Next report is the statement of financial position, which is reflecting the overall financial position of your organization, everything, not just revenue and expenses. It's going to look at your total assets, everything you have, everything you own, everything you're owed, and subtract your total liabilities, everything you owe to others, and give you your net assets, what's left over. A comparable diagram, though it looks more complicated, of statement of financial position. Assets minus liabilities equal net assets. But if you look at what assets consists of, it's your current assets like cash and receivables, but it's also all your fixed assets like your furniture and your building, etc. And it looks at all your liabilities, your current liabilities, the bills you have to pay, the payroll that you need to pay, but also your long-term liabilities, bonds, your mortgage, etc. And together, one minus the other will show you your net assets. And these will be broken up into three types of net assets, which we'll talk about next week, known as unrestricted, temporarily restricted, and permanently restricted. So here is a nice example of a statement of financial position. You'll see that it begins with assets and it totals up current, fixed, and long-term assets to give you your total assets. Then it looks at the liabilities, the current liabilities, the long-term liabilities, and gives you total liabilities. Total assets minus total liabilities will give you your total net assets. In this case, let's say that total assets are $70,000, total liabilities are $3,000, so total net assets are $67,000. The report looks at it almost the reverse way of the equation, saying if we total all the liabilities, which were $3,000, and add them to all the net assets, which is $67,000, 3 plus 67 will equal $70,000. So it's the same equation whether you go to the left or the right. The report will look at the current year and compare it to the prior year, and it will look at both operations, board designated, and your restricted assets. Again, we will go into them in more detail next time, but the totals will all be the same. And finally, a statement of functional expenses, which will break down just your expenses by the three main functions: operations, program expenses, management, and fundraising. And this will look very much like our discussion of direct expenses, which are operations, and indirect, which are management and fundraising. So why is this useful? Well, it'll allow you, your government program managers, your funders, your board, to see at a glance how much money is going into both direct and non-direct services, and again, even within the indirect, comparing management and fundraising. So here is a nice sample of a statement of functional expenses report. You'll see again that there's a breakdown of main expense categories. This kind of report doesn't go into all the specific details, and not every organization is going to have the exact same expense lines. For instance, grants to other organizations would only apply to nonprofits like foundations that are in fact supporting other nonprofits. But typically we've got personnel, supplies, travel, professional fees, occupancy, etc. And then it's going to start by looking at the program, the operational expenses, and we'll break them down by all the different programs an organization is running. So this organization has two programs, Program A and Program B, and you can see very easily that for the point in time, what Program A has spent on salaries, supplies, etc., and what Program B has spent, and we'll subtotal them to tell you all the programmatic, the operational expenses that have been incurred. Then it will also talk about the expenses for the supporting activities, management in general, and fundraising, and what their totals are. So if we look at what's basically personnel expenses, salaries, benefits, and taxes, we can see that, let's say this is 1 month's report. Program A spent $7,400. Program B spent $5,625. And in total, the direct programmatic operational costs for salaries were $13,025. At the same period of time, management salaries were $1,130 and fundraising was $960 for a subtotal of $2,090. And finally, this should total what your total personnel expenses for this period were of $15,115. You can look at total expenses on the bottom for a quick comparison of how all of the expenses have been distributed.